Hey, we're excited to have Matt Sorensen from Directed IRA and KKOS Lawyers with us today. He put out some great content about the big, beautiful bill, and there's been a lot of discussion on this bill. I think it was 1,000 pages or somewhere near that.
Yeah.
So I wanted to bring Matt on the podcast. Not only does he know a lot about directed IRAs and has the #1 book on the topic, but he is also a geek and loves to dig into the bills like this. And
True. Guilty as charged.
So whenever new legislation comes out, and I'm wondering how that's going to impact investors and myself, I always look to see what Matt puts out, and so wanted to bring him on and talk about some of the key parts of this bill, because it's so big. There's so many impacts, and he does such a great job of pulling out that stuff. So maybe want to start for individuals, because there's some impacts to individuals, there's some impacts to businesses. Maybe we start with how this impacts individual investors and some of the positives and the negatives.
Yeah, so there's huge tax incentives here for individuals and businesses. And let me just say, this is not meant to be political. We do have, Donald Trump up there. He did sign this bill. It is in law. This is like in effect now, and a lot of these provisions matter in 2025. I'm just going to hit some of the tax perks that are in there. There's a lot in this bill. I'm not political about it necessarily, but I do like tax breaks, so let's hit those.
Great.
The first thing to keep in mind is last tax reform, like 9 years ago, Congress passed all this tax reform. This is Trump's first administration. And they said, all right, all these big corporate tax cuts are permanent. All the individual cuts, though, expire after 9 years. Because for whatever purposes, for budget and reconciliation, they wanted to score it. If you only do it for under 10 years, you get more favorable treating from a budget standpoint and scoring. So they're like, let's make all the individual ones temporary. And I think if you're a Republican, you were like, well, they're going to have to elect us back to get this permanent.
Right.
So somewhat
makes
political,
sense.
I'll be honest. So these were going away. So all the tax breaks we enjoyed, everybody's tax rate went down 2 to 3%. So like 9 years ago, the 39% bracket became the 37.6% bracket. The 15% bracket became the 12% bracket. So everybody's rate went down like 3 to 2%. Now next year, that was going to all bounce back. What that means was everyone's rate was going to go up 2 to 3% in 2026. So in some ways, we've gotten a little spoiled because we're used to the lower rates. Now it's been 9 years of it, so we're like, but we were all going to see tax increases in 2026. So those were not only extended, the reduction in individual rates, but they were made permanent. So that was the first thing, is reduction in rate.
And that was part of the political calculus, like you're saying, is that if the bill wasn't passed, everyone would see a tax increase. Right. So they were able to kind of say that because this needed to get renewed.
Yeah.
And even though there was some controversy around the bill, Elon basically over the bill, him and Trump had a falling out around it.
I called that. I called the Elon Donald Trump thing will not last. No. I called it so early. I was like, there's not enough room in the White House for those two together.
I mean, 3 months was a long time, or 4 months, however long it lasted. It was longer than I think expected. He did get through the election, and I think that was a bit surprising to everyone that they got through that period, and then they worked together for a period of time. But it was kind of what the straw that broke the camel's back for Elon, because he wanted more cuts. But but we also know there was some positive things in the bill, and that the fact that these tax cuts were extended was certainly a positive.
Yeah, and there's a lot more to it too. Like the standard deduction was doubled, for example. So most middle income or low income taxpayers take what's called the standard deduction. Rather than itemizing your charitable contributions, your mortgage interest, your state and local tax deduction, and like tracking all that, you just say, I'm taking the standard deduction. And again, like 9 years ago, this was doubled and said, whatever the standard deduction is, it's double what it is. And so this doubled standard deduction, which is tens of thousands of dollars, like for a married couple, this is like no chump change. This matters for someone making $100,000. This will save you a couple $1,000s in taxes. This one thing, let alone the rate cut. And so the doubling of the standard deduction was extended as well. Child tax credit was another one. It's right now $2,000 for a child. So if you have kids or planning to have one, That was set to go to $1,000 next year, but it was extended to $2,200 starting in 2026. It's still $2,000 for 2025, but also made permanent. So they kind of said a lot of these tax things that we changed 9 years ago, we're preserving them. We're not only extending them, we're making them permanent in the tax code. So I think for individuals, those are probably like the three big ones that affect most people. Lower rate affects everybody. Doubling standard deduction really benefits the middle class, frankly, because the higher income people
they don't
itemize.
Tap into that. Yeah.
And then you got the child tax credit for those that have kids or are planning to have it. The last one I would say on the individual front is the state and local tax deduction.
Is that the SALT?
Yeah, that's the SALT, and that's the one that got everybody pissed off in the House because there's people in the House that live in high income tax states that are actually Republicans, like a Republican from California, a Republican from New Jersey, or New York that's in the House of Representatives, which has razor thin margins too. And remember, the House only passed this bill by one vote. So like this is super close. But those Republicans were like, hey, our constituents pay a lot of state income tax, and we wanted them to get a deduction for it. So like
On their federal.
On their federal, yeah. It's like so unfair. I kind of think this is like from a tax 101. Like everybody should be able to get behind this. Okay, let's say you make $200,000 a year, right? And you pay the state of California $30,000, right? I got news for you. You didn't make 200 grand. You have 170 now, okay? But the IRS was like, nope, we only count a maximum of a $10,000 deduction if you're state and local tax. So we're saying you made 190. And you're like, where's this other $20,000 I made?
Right.
It went to the state of California as tax. So the federal government is taxing the money you had to send to your state or local government. And so from a tax standpoint, it's not the best. Traditionally, there was an unlimited state and local tax deduction that you could deduct. You paid $1 million of state and local tax, you got $1 million deduction. There was no cap on it. Last tax reform, they put a cap of $10K on it. And now what the compromise was a $40,000 cap on state and local tax. So that's what came out of that. That's the SALT deduction. So it's an increase. So if you're in a high income tax state, you used to only be doing 10. That got bumped up to 40.
Yeah, and that's that ended up being a little higher than in some of the original negotiations. So I think that was a positive for the high income states. When it comes to the individual impacts to higher earners, you talked a little bit about this, but does this benefit high net worth folks the same that it benefits the more middle income and lower folks, in your opinion?
Well, I mean, the hard thing is like on the rate cut, I mean, like the rate staying the lower rate, that benefits the most wealthiest people because they at least have income because they pay more tax.
And that's across the board. Those rate cuts are, no matter your tax bracket, you're going back to those lower rates.
So let's say you got a 2% rate savings under the bill, right? And you make $10 million, like that is a $200,000 tax cut versus someone that makes $100 grand a year and got a $2,000.
So that's going to help everybody.
Yeah. So like everybody gets it, but obviously if you make more, now this is like, again, the partisan nature of it is like, this is a tax break to the wealthy. The one thing that is different in most of the tax cuts that were given, even like no tax on tips, no tax on overtime, child tax credit, state and local tax deduction, those were all have high income phase outs.
Right. Those tend to be, high income phase outs. If you're making over $100,000 a year, you can't tap into that.
Yeah. And like 150 married or 300 on some of them, 400K on the state and local tax. So like high income earners actually don't get a lot of the new tax breaks that are in the bill. So the one that they do benefit from is the preserved rate reduction. But again, they're paying more tax. So I can concede that point at least. But I think everyone wins under this bill from a tax standpoint. There's reasons to be against it, right? They had to cut some things. There was cuts in Medicaid, and right, you could be on the Elon boat and for the renewables issue or the budget deficit issue. But for me, I just like less tax. I'm just like, let's just pay less tax, let it stay in the economy, let the people decide what to do with their money as opposed to the government. They're better at making decisions on where to place capital or whether to spend their dollars than the government's going to be. So let's just like tax less is kind of my philosophy. Not that anyone cares what I think philosophically.
Well, we do.
But,
And
it does matter on my tax return.
And so there's a phase out of some of the green energy sort of incentives. I was at a car dealer a couple weeks ago, and they said, actually it was the Tesla store at a mall.
Yeah.
And they said, yeah, hey, you got to buy this date, September, to get it. So
this
now
year
they're pushing people to buy. So there'll probably be some people move their date up to buy before that expires, and then it goes to zero.
Yeah.
Also, solar companies. I have a bunch of friends in that business that relied a lot on the growth of solar over the past several years on the incentives that you would get. I think it's $8,000 if you put solar on your roof, and maybe the system costs you $30,000. You get $8,000 rebate on your taxes. Those are all going away.
Yeah. Yeah, I mean, there was some, there's a lot of pros and cons. This is Congress. They never do anything everybody likes. So,
well, in fairness, this is what Trump ran on.
Yeah.
And this is what the Republicans ran on. They wanted to do away with these green incentives.
Yeah.
They said they were going to do it.
Yeah.
It's not a surprise.
Yeah.
They said they wanted to decrease some of this long-term Medicaid and folks that were on it for and not working. And so whether you like it or not, it is kind of what they said.
It's what they said they were going to do, and people went and voted for them or voted against them on it if they were paying attention. But, I think on the renewables, I think the biggest shock there is people knew it was going to go away, but they didn't realize it was going to go away immediately. They'd phase it out over a few years. Because, I think for that industry and those businesses, they have supply chains. They've made purchasing decisions, right? And so, and even people thinking about buying it, it's kind of a quick wind up now to take advantage of those incentives if you wanted to do it. So I think industry just has got kind of like a gut punch on it if you were in that renewable space. And so,
and I think that, and again, being nonpartisan, just looking at it from a financial standpoint and an economic standpoint, that is one of the big challenges with this first 6 months of this new administration is these things are big changes, and they're happening very quickly. That's a good point. If you think about tariffs and some of the plans around tariffs to onshore, onshoring manufacturing takes so long and takes significant investment to bring some of that onshore that it's created some uncertainty definitely from business leader standpoint, because they don't know if this is going to last just this administration. Is it going to, if I go make this onshore investment, is it going to pay off, or is the next administration just going to wipe those tariffs away?
Exactly. And by the time I get that up and running and I start making money, realizing my investment is the tariff's going to go, and it's going to be cheaper for me to go back offshore.
Right.
And so I think, and I think that's, the big issue with the Fed, of course, and the Trump versus Powell debate is Trump's running tariff. He's doing massive fiscal spending and fiscal policy stimulation with this tax bill, yet he wants rates to go down. Those are the two things that the federal government can do to ensure there's inflation. Tariffs and put money back into the economy, which is reducing taxes, and a big bill like this that has a ton of government spending does both of those things. And so he's yelling at Powell to try and raise rate or to lower rates right now. So I think it's a tricky place that we're in. But let me hit the business.
Yeah, ones. Let's go to that. So you might be a business owner, small business owner. You might work at a company that it impacts. What are the main parts for the business side?
Yeah, even real estate investors, on the first one, bonus depreciation.
Oh, that's huge.
So again, go back to the last tax reform 9 years ago. They said, hey, when you buy something like a capital asset, whether this is in your rental property or this is equipment in your business or a qualifying vehicle even, let's say that the shelf life of that asset is 7 years, and it's $70,000, you can expense $10,000 a year. That's general depreciation, how you're writing an asset off over time. But with bonus depreciation, they said, you can do 100% of that year one. Now, there's some rules and some limitations, but it's actually very generous. We had a ton of our small business owner clients at KKOS Lawyers benefit from this. And whether it's the vehicle or the equipment, you spend that $70,000, like in that example, you have a $70,000 deduction. Even if you got a loan to buy that and you only put $1 down, nothing down, you got the whole deduction, even though you might have got a loan to acquire it. Plus, you're going to write off the interest on the loan too, of course. So huge tax break. We had a lot of businesses, particularly at year end, looking at their tax situation, small business owner, where can I get write-offs? I want to grow and scale my business. Maybe it's a good time to add equipment or a qualifying vehicle, take that tax deduction and start trying to grow the business. So that was bonus depreciation. And this could even be your rental properties too, where you're putting assets into it, or maybe doing a cost segregation now and analyzing the assets in there to take.
Yeah, that's what I was
depreciation.
just going to hit on, is that ability to pull some of that depreciation forward, because typically we're at 27 and a half years. You do straight line depreciation on an asset. But if you, especially if you've done a big reinvestment, a big renovation, you can do a cost segregation study, and that bonus depreciation can be brought forward in addition to what you would normally do on the cost segregation study. So that's something that has been utilized for several years, and now that's going to continue, that ability.
Yeah, so that's a cool one that came back, and that was also made permanent as well.
Okay, so no expiration. Which is,
no expiration on that. That was one that, again, when they passed it last time, they kind of phased it down year to year. The 100% bonus depreciation right now is 40% is what it was going to be. But this is one that goes into effect in 2025 too. 100% is back in 2025. Like, this can help you on your return now. So for any of you business owners that have been looking at buying equipment, or a qualifying vehicle, or a real estate investor looking to maybe cost seg even an existing property, or actually for new assets that you're going to put in to play, you can look at the bonus depreciation. But there was another one I still love though, which was QBI, okay, qualified business income. It's a 20% deduction that a small business owner gets. So I hate to keep going back to last tax reform, but it's like relevant to what the hell these provisions are, which was last tax reform, big corporations, which are typically C corporations, were paying a corporate tax of 35%. Then they pay out a dividend, and the shareholder gets a dividend and pays a dividend tax. In last tax reform, they said that 35% is being reduced 16% down to 21%. So the federal corporate tax is now 21%, and they fixed it and made it permanent.
Amazing, and much more competitive globally than the 36%, because 21 is still higher than most countries, but it's much more competitive.
Yeah,
than
and then the shareholder still gets taxed at, let's say, 20% on the dividend down. So it's not like it's just 21% is all they're paying. Like, that's what the corporation pays, and then they pay it to their shareholders, and they're paying tax again. So it's called that double taxation. But let's say it's 41%, which is, if you go across the world, like worldwide, that's not that competitive.
No.
So we're still pretty highly taxed. But when they did that large reduction, they said, small business, we still got something for you, because small business owners were like, well, what the hell? We're not C corporations. We're S corporations and LLCs. We don't do that big corporate structure. And they said, here's what we got for you, small business. We're giving you a 20% deduction on your qualifying business income. So let's say you're a business owner that made $200,000 during the year. You got a 20% deduction. That's a $40,000 deduction. You only paid tax as if you made $160,000. So that was a huge savings and benefit for small business owners. Again, this is if you're an S corporation or a partnership, sole proprietor, LLC, doesn't matter. You get that QBI of 20%. Now that was going to expire. This was the last year of it, so it was no more in 2026. So that got extended and also made permanent.
Wow.
So for any small business owners, you may have been seeing this on your tax return. It's probably one of the most easiest to utilize. It's kind of like, I get it. Now, if you're like in what they call a specific service or trade business, or like an SST, I forget what the acronym is, but there's certain professions and trades that have phase outs for it, like doctors and lawyers, where if they're making like 300 or 400 grand or more a year, it starts phasing down the value of it. So like even me, like on my law firm's income, I get phased out on it. But for most business owners, they can play in it. It's just certain like professions, for whatever reason, Congress doesn't love. I don't know why they don't give love to the lawyers and doctors,
I do. No.
Yeah. It was like the architects got a pass, I think, the engineers. It's like, what the hell?
It's weird how
the lobbyists for the lawyers are like the worst. Like the American Bar Association is like, what are you guys
get their
doing?
act together.
Yeah. So, anyways, that one's made permanent, 20% QBI. Great for small business owners. And this is if you got a side hustle, main hustle, big business, small business, you can take advantage of this as long as you're an S corp, LLC, sole proprietorship, partnership.
So a couple more questions. Maybe I should have led with this, but
yeah.
So this bill's been called the Big Beautiful Bill.
Yeah, one big beautiful bill.
One big beautiful bill. Is it a big beautiful bill? What do you think?
Well, I'm a tax guy, so for me it is. I looked in the corners of the tax savings and benefits from that standpoint. I think it's pretty beautiful for people that pay taxes. And I think just for me, and again, like for just like helping clients and small business owners, I mean, it's tough, like going out there, running a business, trying to scale, provide jobs, like you take a lot of risk. And for a lot of those business deductions we just talked about, I mean, they were stuff that business owners got the incentive for, and it was a nice incentive. And I think any more money we can put back in their pocket, which helps stimulate the economy, grow jobs, I think is beneficial. And then all the individual stuff I thought was very fair and balanced on how they did it. I think anybody that says this was a tax break for the wealthy is just like smoking something. Like that is just not reality. The vast majority of the cuts in there have high income phase outs. Like they were specifically targeted for middle income and lower income individuals to take advantage of. So I think there's kind of something in there for everyone in terms of tax reduction.
And it was pretty impressive that even within the Republican coalition, there's a lot of factions, people wanting different things. It was pretty impressive that they were able to pass a complicated bill like this, both at the House and the Senate. And then the Senate made some changes, sent it back to the House, and it was passed again. So it was, this is the real opportunity for this administration they have both houses of Congress to get stuff done in the first year and a half. So if you don't like the administration, your head is spinning because they're doing so much. But this is really the only window that they can, because as we get into next year and we have another round of elections, they could probably lose the House, and they probably will lose the House. Typically, that's what happens. So right now is when they get the most stuff done. The last question is maybe the hardest. So there's a lot of tax breaks. There's an argument as to how those were spread, but it does seem like there's a lot for lower income folks that people will like. Mm-hmm. The big blaring issue is what this does to our deficit. And any thoughts on what we do when it comes to deficit to try to first off, reduce our annual deficit, and then to go to the 36 trillion or so that we're paying interest on right now?
Yeah, I mean, if you have the solution to that, you should like go run for something, some high office. I mean, I just think that you don't solve the deficit problem and our problem with our government that spends too much, in my opinion, by giving it more money. And you kind of, to me, you solve it by starving it. I mean, like, just think if you're a household and you're spending too much money on things or whatever, you just keep throwing more money at it and saying, let's just keep taxing or throwing more money into the bad decisions we're making. So I think there needs to be a reality check on entitlement programs. That's where most of the budget goes. But I think like even defense spending, I thought the Trump administration was trying to make big inroads there. I don't know that they have. I think DOGE kind of scratched the surface on things. So I don't know. I'm like more of a free market political person, limited government.
Yeah.
But then I'm like socially liberal and moderate. Not anybody cares about my politics. So I like safety net social programs. I think like that's a role of the federal government, and they should be funding a lot of safety net social programs. I mean, really, I think probably the best example is Bill Clinton. People forget he was the last guy to balance the budget.
Yeah,
was Bill Clinton, and he had a Republican Congress. Yeah, and Newt Gingrich can take a victory lap for that. I think he was Speaker of the House. But Clinton was the last person to balance the budget. But he worked across the aisle on welfare reform and a lot of other items. So I think it really is going to take both parties to come together on it. That's the only way you're going to get a balanced budget. And states have to balance it.
Yeah,
it's just crazy. The federal government they've just gotten used to not having to do it.
I think it was Ray Dalio, who is a big one of the investors on Wall Street that everyone looks to. It's kind of the godfather of Wall Street. Yeah. And he's really become vocal about how the U.S. is positioned, financially. And he went and spent some time in Washington, D.C. around when the bill was getting passed. And he just said there is no incentive, no intention from Washington right now to really tackle the deficit.
Right.
And his takeaway was, but that until there is some pullback in our bond market where we can't sell our T-bills to the public, that there's probably not going to be enough incentive for Washington to do anything about it. And we don't want that to happen because we can sell our debt very freely and we have plenty of buyers on that side. But his feeling was right now they're just, even with $35 trillion, which is well over our annual GDP, there's just not the incentive to do that, and maybe that's what is going to require us to actually make those hard decisions. But that's another podcast. We wanted to focus on the one beautiful bill. I don't think so. I think that was a fair view of it, and I think for everyday folks, just to understand what Washington's doing right now, they're doing a lot. We see a lot in the headlines, but I think this gets under the hood, so to speak, what this big bill ended up impacting our lives.
Yeah, and it's hitting your tax return. So like everybody's got to file a 1040. It's like this matters to you. I mean, some people are impacted in other ways, whether it's the renewables or some of the entitlement reform stuff. But but everybody has their tax return is going to be different because of this bill. And for the most part, it means more money in your pocket, less going to the IRS. So
we'll take it.
I think that's good. Yeah.
All right.